Okay, Dan and everybody, welcome to our October podcast. And I have to say up front, Dan, you broke me down this month. You finally did it. If you look back at a series of our podcasts, you'll see I've always had a blazer on.
Yep.
In fact, we started our webinars always wore the tie.
Yep.
And then if you look sequentially at every single podcast, you'll see Dan's been getting more and more casual. He first went without the tie, and so here we are. And now we're donning our new CPW golf shirts.
And the thought process was, one of the main topics we want to talk about today is what's going on with AI and tech. And we said, hey, how to be more appropriate than to look like we're part of the Best Buy Geek Squad.
We did, yeah, in the office. Yeah, full disclosure, a couple of weeks ago when we pulled out the shirts, I think there was 6 of us. We all had our shirts on, and we did look like Best Buy employees, but they're pretty snappy, and they're good. We've tried them out in the golf outing. It did not help my golf game at all, but they look okay.
That's okay. So, that stuff comes with time. We'll get there.
Yes, great. So back to the markets. Well, it was another good month for stocks, and if you recall last month, we were talking about entering September. And we said last month that September is typically the worst month of the year, and particularly the last 5 years had been pretty bad.
Yep.
Didn't happen this time. We ended up having a pretty nice September rally. The rally continued. And in fact, the S&P posted its 5th consecutive monthly gain. And I think for the NASDAQ, it was 6 months in a row, right? And then another thing that came out of nowhere really is small caps. Small caps had a big September month, and now small caps have been up for 5 months in a row. The Russell 2000 small cap index hit an all-time high, and I don't know if you caught it. I think it was notable. It was the first all-time high since November of 2021. So that has really lagged behind, but it made a big move.
Well, it's still, though, the one thing I think we want to see, right, is markets have continued to grind higher, but breadth in the markets is still pretty narrow.
Right.
Which kind of, I think, dovetails pretty nicely into what we want to talk about today in terms of tech and AI. But it was good. It was good to see some small cap participation. Mid caps still a little bit under pressure and certainly lagging the broader markets. But hopefully, as we head into year end, we start to see it kind of broaden out a little bit. We had taste of that over the summer.
We did. And then it came back to big tech again. So let's quickly go over a couple of the numbers, and we'll go into our topics of the month. Let's go to the Dow first. Dow in September had a good month, solid, up about 1.87%. That put it up about 5.2% for the third quarter. We're now into October, so we finished the third quarter. S&P, same kind of story, up 3.5% last month, finished the third quarter up about 7.8%. That was strong. And of course, the NASDAQ did what it's been doing of late, up about 5.6% in September. That put it up over 11% for the quarter, and it led the way, except for small caps. The Russell 2000 was up about 12% for the quarter, so that led the way. And we mentioned the NASDAQ. Well, it's kind of notable. It had another great month and quarter, but it wasn't every one of the Magnificent Seven stocks that were higher. We did have a big move by Tesla. We'll get your comments on that because Tesla was up 40% for the quarter, and it looks like the chart kind of changed when Elon Musk kind of left his day job at the White House and came back to Tesla. It's up big time.
No, and I think that's a fair observation. Especially during the Doge period, and there's a lot of bad press there. You obviously had the protests at the Tesla dealerships, and I think there was a real thought upon among retail investors and certainly market participants that he had kind of taken his eye off the prize, and Tesla, of all of his portfolio of companies, was kind of the one that was getting the least amount of attention from him. And it seems like he's really dialed back in. Still a lot of challenges with that particular name, and I think in this political environment, but it was nice to see at least a little bit of mean reversion there and make up some of that lost ground.
And he had a pretty decent compensation package that they attempted to. I lost track of whether that got approved, but it was some pretty big numbers.
Yeah, well, it would be nice for any of us to have a $40 billion plus compensation package pushed through.
And I think just through yesterday, they were saying he's the first $500 billion person. So I think his net worth was over $500 billion as of yesterday's price thing. So not too shabby. So the other Magnificent Seven that we're all talking about, Apple, looks like Apple had a strong quarter, up around 20%. And that's a good recovery because Apple had been struggling the early part of the year had been negative up and through September. Nvidia up again, another 18% for the third quarter. Google up 14% for the quarter. But the two that struggled were Facebook and Amazon. They were about flat for the third quarter. So that was a bit unusual. And Microsoft, a little bit just moderate growth, up about 4 or 5% for the quarter.
Yeah, and the story really is still it's so dialed into AI, and specifically, use cases, semis have continued to rocket upward. Cloud and data to a lesser extent, but you're at that point now where the capex spend among all these companies for AI is still very elevated. There's no signs of that slowing down in the near term. In fact, I was looking at a report out of Citi where they're projecting $2.8 trillion of AI capex by 2029,
Wow.
which is a pretty wild figure. But for the quarter, I mean, you think about it. Microsoft, they did, excuse me, not the quarter, for fiscal year. So far, about $80 billion of capex so far this year.
Wow.
Google about 85 billion, and Meta in that kind of 65 to 70 billion range. So they're all putting their money where their mouth is. They're really spending. It's just we'll be limited by power and grid and
Right.
data storage. So.
Yeah, so summing up, the third quarter continued the pattern we've had last several quarters, which is technology led the way.
Yeah.
The technology sector is up about 13%, followed by communication service, which is like quasi tech. I mean, communication service is basically the index is Google and Facebook. I think they're like 30% of the XLC, which is the largest ETF in that sector, and then consumer discretionary, that was up about close to 10% as well, and that's mostly Tesla, as we mentioned, and Amazon. So the big get bigger, and then the underperformers were the more conservative sectors. Consumer staples were down about 3% for the quarter. Real estate was up, 1.7%, and materials up a little over 2%. Oh, notable also, financials were only up about 2.86. I was surprised by that because they have been mentioned as a beneficiary of the Fed cutting rates. We finally cut rates in September, and they're still not moving
Well, I
as
think
much.
there's a little bit there too, where the Fed rate cut was not kind of the feel good moment, right? When you talked about rate cuts, say coming into the year, the thought process was that inflation was going to be, underhand,
Right.
and that the economy would be in a strong enough place where, maybe some slight weakening, but it could justify that rate
Absolutely.
increase. With inflation being, very sticky and persistent, inconsistencies around government data figures and, the shutdown, all those sorts of items, I think it was almost more of like, we kind of have to cut rather
Right.
than we're excited about the cut. And even in the labor markets, I mean, we saw those ADP figures that were, I mean, talk about a miss. And then on
Yeah,
top of that,
revisions, yeah.
you're getting, at least in the labor market side, you're getting kind of some amongst college grads, almost hesitant to say this and knock on wood here, but it's almost like a 2008, 2009 type hiring environment for them where you've got close to double digit unemployment among recent college grads. So I think it was more of a relief than a reason to get very excited, in my estimation.
Absolutely. And, some dissension amongst the crowd, and more to come on that, certainly as the months go
Yeah.
on. The Fed is not united the way it has been in the past. So speaking of history, one of the concepts of this podcast and our webinar that we've done 4 years prior is to kind of go a little bit deeper on a couple items that might be on the mind of clients. And I think the biggest thing on the mind of clients right now is does, the question is, it kind of reminds me of Mark Twain, the old saying, I think it is history doesn't repeat itself, but it does rhyme a
Right.
little bit. So the question is, does this rhyme, does this market here rhyme with 1999? In fact, on CNBC, or maybe it was Bloomberg today, I heard the Prince song from 1999. So they're playing that theme.
Yeah.
And so that's our topic for this month. We're going to go a little bit deeper to compare. There's definitely some similarities. We'll show you a couple charts, and there's definitely some differences though this time.
Yeah.
So you want to kick that off, and we'll kick it back and forth.
Yeah, and this was a really fun. I mean, obviously, it's a question we've been getting a lot from clients, but this was a really fun exercise for me as well. I would love to be able to say that I was actively investing money during the dot com bust, but that would not be the case. So definitely a student of the markets and very familiar with it. But it was fun to go back and really look at some of these valuations and kind of, look at the broader context of where the world was at that time. So I was just as excited for this episode as I think clients are in terms of asking that question. But um, yeah, I think the first thing that stood out to me, and Brett, you would know this certainly better than I, but it
Yeah.
seems like despite the fact that there are a lot of valuation similarities, the strength of the underlying companies and balance sheets and kind of utilization of the underlying technology
Hmm.
seems more real now than
Absolutely.
in the late 90s.
Absolutely. Yeah, but it's okay. I think the first go back to why the question's being asked. That part makes sense. You mentioned
Definitely.
valuation, but if you just look sheer numbers, and we've been hearing this off and on all year because it was the first time. If you look at the S&P, 2023, 2024, that we've had back-to-back 20% plus gains, and you have to go all the way back to 1999, and you had five in a row. So
Yeah.
from 1995 to 1999, you had 20 plus percent gains. And I happened to start in the industry in 1994, so I went through it a bit. That was it. So in 1994, you had a really bad bond market. The Fed raised rates a lot. It was a negative year for the stock market and the bond market. Then it took off in 1995. We have some of the numbers in front of us. So there were, comparisons, that 20% comparison, but it went up a lot more, the S&P. If you look at it, just comparing numbers, that 5-year period averaged about not about, a 28.5% annualized growth rate between 95 and 99. Okay, so that was about
Yeah.
250% increase. Right now, we're averaging for the last 5 years is something not too shabby, 13.5%. So it's you have, a good market, but it's not as overcooked. The other thing is you mentioned it. So, the companies like the largest market cap back then, I think AOL was the big one, right? AOL got to something like 200 billion market cap. It had like 20 million customers, something like that,
Yeah.
and never made a profit. So AOL was the blue chip. But then you had pets.com, famously, all these
And
companies that came in
one
and
I
out.
learned about during my research,
Webvan, I
Webvan,
don't remember that
and
one. Yeah.
then yeah, so and I think there's another interesting thing that I was looking at, and it was kind of okay. So internet adoption was incredibly low in the early part of the 90s, and you had Mosaic that kind of came out as their first web browser that was somewhat user friendly,
Hmm.
right? And I think the year that Mosaic came out, uh, internet utilization went from about around 2% across the country to about 20% of households,
Right.
right? So it
Yep.
was a dramatic increase. Then when Netscape came out, Netscape was later purchased by AOL. To your point,
Right.
Netscape was one of those where very famously the IPO was repriced a couple days before. They doubled the offering price.
Right.
They doubled the share amount. I think it was Frank Quattrone was the
Right.
banker for that. And then I think and again, you might have this figure in front of you,
Right.
but I believe on its IPO day, it was almost 100+% return. Um,
Well, the average IPO, you were looking at those numbers. The
yeah, it
average
was.
IPO back then was 100%.
Yeah,
That, yeah.
yeah, it was
Yeah.
I was specifically in
Yeah.
Q4 of 2000 plus 107% on an IPO, and then the average first IPO day over that whole period of the tech cycle was plus 90%,
Right.
which is crazy.
Yeah, and I can tell you, there's a thing called a Munder NetNet Fund in 1998, 1999. I remember had two back-to-back 100% growth years. And we forget, I'm looking at the performance numbers of the NASDAQ in 1999, that NASDAQ doubled over a 1-year period. The full year return was 86%, but for a 12-month period through
It's
November,
wild.
the NASDAQ had double. So if you go, I'll give you the 5-year numbers: 95 up 39%, 96 up 23%, 97 up 22%, 98 up 40%, and then that 86% blow off. So if we are, and there's some, some of these, companies, if we are in some kind of AI bubble, we probably have further to go if you want to make that comparison, because that blow off top was, still a doubling after we got to the frothy levels. And
Definitely, and even if you look at some of the market, like the broader market valuation metrics, right? So you look at the Schiller Cape in 2000, it was 44.
right,
Okay, and you had 48 times forward earnings
right,
across the market. Right now, you've got Schiller Cape as of mid 2024 was about 32 to 33. I think it's closer to 38 now as of the end of September. But you're looking at tech on average trading somewhere in the 31 to 33 times.
right.
So still, richly
But they
valued,
have
but
earnings,
but
right,
they have earnings
right.
exactly.
The biggest of
Um,
the big have earnings,
yeah,
which is different. And that's a great point, Dan. So let's show a chart, because we have a chart here. And what we're looking at here goes back to 1994. And we're looking at the S&P 500 valuations. Again, this is why the question's coming up. You see that peak back in 2000, where forward valuations were something about 23 on the S&P 500 forward earnings, and they're there again. They're close to that right now, but we have a much higher probability that earnings are going to be sustainable,
yeah.
going forward into next year. In fact, earnings estimates are something like 13% for 2026 and 2027, probably different than what happened in 2000 and 2001, certainly.
Definitely. I think what's kind of interesting too, which is I think is on the mind of clients is, everyone remembers the famous Greenspan line of irrational
Irrational.
exuberance,
Right.
but people forget that that was like 4 years
It's
ahead
like
of
96, right? Not
the
99.
crash. And
Yeah.
and I guess what I keep thinking about is, where are we at in the irrational exuberance cycle? Do you think that right now we are closer to that, inflection point, whatever that ends up looking like? Or do you think that, while we've gotten off to a hot start, that maybe there's, a greater length of ball game left here?
Yeah, I think it's hard to give the innings thing, but I love the way you said that, because I think Greenspan was right at the time. We had a big increase in valuations. It just can go on longer than you think. But
Like,
certainly right now is a time to be a little prudent. And
yeah,
we'll talk about that. Maybe one lesson from living through the late 90s would have been, if you just, I remember a few clients that we had where we had things like, if you had value funds through. And then, by the way, the blow up was spectacular. The Nasdaq, we mentioned these 100% returns, but it was down peak to trough something like 80%.
yeah,
Okay, it's from 2000 to 2002. So some real losses. But if you had value stocks back then, even like a QGARP, like quality growth at a reasonable price, even if it was growth stocks, but they had some kind of filter for for valuations, you held up very well.
yeah.
Global stocks did okay. But if you just stayed in those tech stocks, you pretty much got buried. So second chart, and here's that period. That period run up. You see on this long term chart of the S&P, you see that 106% move that is showing you. This just picks it up in 1997 to the peak there. And then you see the spectacular S&P, about a 49% correction, Nasdaq 80% correction. Then you see where we are now, another big move. Who knows what the future is going to bring, but why not take some profits? Why not shift back to dividend
Yeah.
payers? Value is very much undervalued. Why not show some prudence? If not now, maybe towards the end of the year, we'll be talking to more clients about that.
And I can't agree with that more. And I think, again, I'm hesitant to use kind of clients as a proxy for this, but one of the things I think that has been prudent over time is, as the conversation and the narrative continues to become more and more and more AI focused,
Right.
the contrarian in me is just screaming to say, like, hey, it's time to do some reallocation, and make sure that you still have that balanced portfolio. It's so easy to want to chase these gains, and there's no indication that the gains are going to stop in the near term, but I think having that measure of kind of prudence and diversification is wise in a market like this.
Right. Here's a third chart. It's looking at value versus growth, price to earnings discount. And you had a huge discount in 2000. Now, I'm reminded that a lot of our clients are listening to our podcast in the car and stuff, so they're
Yeah,
not watching the chart. But if you are watching the chart, what you'll see is in 2000, this beginning of 2000, value was 70% cheaper than growth on a relative basis. And, and then value outperformed dramatically during that sell-off period. And we're now close to another peak in where where value is very much
Yeah,
undervalued relative to growth. So we could go on a little bit longer for growth, but it's a good time to rebalance a bit.
definitely. I could not agree with that more.
Uh, Another way of looking at it, we have a chart here that shows if you look at a 60-40 portfolio drift, so this goes back to January of 2019. So if you started a portfolio in January 2019, what is that, about 6 years ago?
Yeah.
And your allocation was 60-40 stocks bonds, right? It's kind of interesting. And if you set that portfolio, that's 60% stocks in a pretty simplistic 25% growth, large cap growth, 25% large cap value, uh, 10% international, then 40% bonds. If you didn't rebalance, it's way out of whack. So if you come to it now, that same portfolio, if you reinvested
Yeah.
dividends on both the stock and bond side, by the way, this chart's courtesy of JP Morgan, their guide to the market, what you would have, you'd be pretty overweighted. And I suspect a lot of portfolios like this right now, you'd have, instead of 25% growth stocks, large cap growth, you would have 38% large cap growth. You'd have only, what's that, you'd have 26% value. And basically, you'd be 75-25 stocks and bonds,
It's
right?
interesting too, though, how the international exposure has been constant over that period of
Right.
time.
Interesting.
I
Yeah,
mean, I think we saw too a lot of investors coming into the year like heavily underweighted international,
absolutely.
and it just speaks again to that kind of concept of you want to be spreading your risk and diversifying out, and not just being so caught up in chasing
Right.
growth.
And international has still outperformed this year. We don't talk a lot about it, and
Yep.
people aren't asking for it. Anything else that would parallel? I think it's worth bringing up. Not just. I thought this was pretty funny, Dan. Not just the 90s, but you're also hearing this week a lot of talk of the 1960s. And if you look back at the 1960s, believe it or not, the 1960s had the Nifty 50 run
Yep.
up before that. So there was a pretty famous Nifty 50 run up. There was these Nifty 50 stocks. I'm looking for my chart on that, but and then you had a bust. The Nifty 50 stocks bust. But you can find articles from back in the mid 60s that will say that there was an overvaluation of high flying tech stocks. And the high flying tech stocks back then were IBM, Xerox, and Polaroid. So I don't know if you ever remember
Yeah.
Polaroid, but it was once considered in the 60s a high flying tech stock.
So here's our question then.
Yeah.
For today's companies, who is our IBM, Xerox, and Polaroid of this Mag 7 group,
Interesting. Yeah.
right? Because
Right.
I think for all of those companies you could kind of point to, I mean, and people kind of forget, they think of Xerox now as copying machines, but Xerox was an absolute just dominant market player in high-end technology, and a lot of the things we take for granted now came out of their R&D, and the
Right.
same with IBM. And it'll be curious to see what companies kind of fail to meet the moment in terms of evolving and adapting as this AI, environment we find ourselves in inevitably changes.
Absolutely. Which brings us to our last chart, but it is our chart of the month. Because if you look back, we have in front of us, for those of you who are not listening to the video, we know the largest 10 market cap companies now, right?
Yeah.
They're all the Magnificent Seven: the Apple, NVIDIA, Microsoft, Amazon, Alphabet, which is Google, Facebook, which is Meta, Tesla, Broadcom, Berkshire Hathaway, and JP Morgan. But if you look back every decade, so just 10 years ago, the largest 10 companies were completely different. The only two that are still on the list is Apple and JP Morgan. So you had, the
On
largest 10.
Microsoft too.
Yeah, Microsoft's on there too. So there's three, right? So 30%.
Yeah.
So you have, but among the largest 10 years ago, it was Apple, as we mentioned, ExxonMobil, Microsoft, J&J, Berkshire Hathaway, Wells Fargo, GE, Procter and Gamble, and Chevron.
Yeah.
Right. And go 10 years back, 2005. How many do you have? How many repeats there? It looks like you only have, I think you just have Microsoft. So 2005, top 10 companies were IBM, AIG, J&J, Bank of America, Pfizer, Walmart, Citibank, Microsoft,
What I find very
NG.
interesting about these lists, even more so than the change of leadership, is also the change of construction. And what I mean by
Right,
that
the
is
industry, yeah.
the industry breakdown is way, way more diverse
Great
going
point.
back through the decades. And that was something that, I was curious about when I looked at the dot-com era versus today was, what was kind of the leadership concentration? And I think some will be surprised to know that right now it's about 34% roughly of the S&P is made up of the Mag 7.
Mhm.
That's a higher concentration than in the 2000 dot-com era,
Right.
right? You were high 20s as opposed to mid 30s.
Yeah.
So, that's what's most curious to me is that you look at that list and it's all basically semis or tech. You've got JP Morgan and Berkshire as kind of you know, uh, the lone non-tech companies in that top 10.
Interesting, yeah, because if you look at it, comparing the numbers, you had the top 10 back in the late '90s accounted for 27%
Yep.
of the market cap, okay? Now you have the top 10
Yeah,
right
right
that
around
we read.
34.
Yeah, and actually through yesterday, believe it or not, they're up to 37
It's
because
wild.
they continue to flow. Yeah, but that's a great question. So the $1,000,000 question would be if you go back further, like 1985, it was pretty diverse as far as the sectors. The
Yeah.
top 10 companies were, again, IBM, ExxonMobil, GE, but you also had General Motors, AT&T, Shell, Aramco, Royal Dutch, Kodak, and DuPont.
So very heavy on energy in the
Yeah,
80s.
right, right.
And it'll be curious to see over the next couple years because I think, one of the, I think, anecdotes that kind of tracks for the environment we're in is when people think of, say, the gold rush of the late, the what, 1849, right? And you think about it, originally you're going out to try and, pan for gold in the rivers. And
Right.
then who are the people that ended up making the real money out of that? It was who was selling the picks and the shovels and the filtering screens and all that sort of stuff. And I think if you look over the next 5 to 10 years, certainly these big tech companies will continue to be massive players and massive profit centers in the AI boom. But you'll start to see probably a more diverse smattering of companies that are really taking advantage of this technology. And you might see some diversification re enter into the marketplace as opposed to just stay so concentrated on the enabling factors.
But this chart shows us if you look at history, if you go out to 2035,
Yeah.
most likely
It's going to be
uh,
different
it's
leadership.
going to be different leadership. It's not going to be the 10, the 10 tech stocks, with
Yeah.
Berkshire Hathaway and JP Morgan attached.
Now
Or
here's your question, or maybe this is our gentleman's bet. Do you think Berkshire will remain on that list? It's kind of a conglomerate and market proxy in and of itself.
yeah, you wonder. And we know Warren Buffett is transferring ownership over, but there certainly will be some. Another interesting thing to look at is if you had to look at the next on deck companies, you'd look towards the private companies,
Yeah.
right? Private companies that potentially could go public. But if you look at the private companies, then you would have who are the largest private companies? They're going to be
Your
technology,
open AI, Anthropics, et cetera,
SpaceX, right?
SpaceX.
Yeah.
So you could see a pretty similar mix, at least sector wise, but I do think you'll have some naming, swaps that go on there and some changes in leadership.
Yeah, it's
So,
interesting, and it'll be stuff, definitely stuff that we don't know about. Like
he-
Nvidia 10 years ago, we wouldn't have pulled Nvidia out because we didn't know about AI.
yeah, it would have been different. You might see something like quantum computing stocks. There's some names out there that have participated in some of this run up, but certainly not to the same extent. So again, it's what did the great one Wayne Gretzky say? Know where the puck's going, not where it's been. That's kind of the $64 million question right now to age myself is where's the puck going? And I think AI is going to be obviously a big part of that, but there will probably be industries and sectors that we're not considering.
And I would say if AI, you mentioned Berkshire Hathaway, so if it's insurance companies, they're going to be able to use AI to be
Yeah.
more efficient as well. It's not just going to be the semiconductors that are making the chip. Like AMD today's got a big deal out, right? But it's not going to be all the AMDs. It could be insurance, healthcare.
What do you make of that too,
Yeah.
right? Because that's now two chip companies. So you had NVIDIA, what, last week or 2 weeks ago with OpenAI, and then you have AMD. today,
Right.
where you kind of have this circular investment going on where the chip companies are generating profits from the promise of AI, and then they're plugging it right back into the AI companies. Is that a concern for you?
It all seems a little financial
Right.
manufacturing, which it pushes you a little bit back to 1999. You see all these, all the companies coming public,
Yeah.
mergers. You see a lower regulatory environment. Some of it does smell like bubbles in
Yeah.
certain area. You wonder about these when you see so many different announcements. When you go through, you wake up on Monday morning and there's several mergers. We had a decent sized bank merger again today. We had one last week. So, that I think we could push forward through this in the fourth quarter. If you look at what we think, I say what we think, we're relying on Goldman Sachs primarily as our custodian for our clients. So we read a lot of the Goldman Sachs research. They recently, on September 29th, overweighted equities going into the year end from neutral to overweight. So they think it's going to go a little bit further.
Yeah.
But we certainly, I think the theme of today should be a little bit of prudence. And I think we'll be talking to clients over the remaining part of the year, towards the end of the year, about potentially, shifting, rebalancing the portfolio with a little bit more value, a little bit more international, just out of
Yeah.
prudence, because we really don't know where this thing's going to go, but we know there's a lot of hype and excitement right now. And when you
Absolutely.
see those deals, it kind of scares me a little bit.
Yeah. Yeah. I mean, I just, you hope we've learned some lessons from the past, but it's just, you got to be vigilant in today's market.
Great. Anything else on your mind with the did we beat the drum too far on the 1999
No, I
topic?
mean, I think the big takeaway I would leave people with is that while there's definitely similarities, there are fundamental key differences. And I think AI, as opposed to that period of time in the late 90s, AI is producing, you know, measurable value for companies. They're starting to monetize, there's adoption, and the underlying companies involved have real businesses that, while AI has definitely expanded their valuations, it's not the only game in town on their balance sheets. So, while I'm cautious and hesitant as always, I don't think we're quite in that, irrational exuberance mania that we found ourselves in the late 90s.
Right. So shift gears then between now and the end of the year. I like reading Fundstrat research. Tom Lee has been correct, although he's been bullish.
Yeah.
So that's one way of being correct over the last several years. But he points out recently in a note just yesterday, since 1950, stocks have notched a median gain of 4.9% in the period from October to December. So now what we
Wow.
said last month kind of reverses itself, because we said September was the worst month of the year, and we're entering a little bit of a seasonably difficult period. We're now in a seasonably positive period. So we know October's had some big downturns in the past, but if you look at the fourth quarter, has been positive. So since 1950, Tom Lee points out that the period from October to December has about an 81% win ratio. So, and then if you overlay that with a period of time where the Fed is cutting rates, a couple notable time periods would be 1998 and 2024. Just
Yeah.
last year, the Fed did a rate cut in September. If you look at periods where the Fed's cutting rates in the fourth quarter, the average return for those particular 2 years was 13.8% for the
Wow.
fourth quarter. So we have the kind of wind and charts at our back right
Back.
now.
Well, and I hope that continues into the end of the year. I mean, it seems like things are setting up to be positive, but there's a lot of variables out there, and going into September, you're thinking, okay, your risk is to the downside, but you're surprised in September. I hope we're not surprised in the opposite direction for the remainder of the year.
Yeah, and sometimes, from forecasting, we've talked to clients in the past, sometimes you can use things like University of
Yeah.
Michigan sentiment study as a contrary indicator. Sometimes when everybody is negative on the market from a sentiment standpoint, you end up having a
Yeah.
good 12-month return. This is another thing that's a little bit scary. You're hearing a lot of the same tune that this fourth quarter is going to be big. It's hard to know what's going to disrupt or what could disrupt this fourth quarter, but I think we do know that why not take some chips off, especially if we push off a little
Yeah.
bit more from here. Bonds aren't bad right now when you look at the coupon, at least
Yeah, I
you're
mean,
starting with. And if rates go down, that's not a bad rate of return. And
exactly.
again, value stocks are
Yes.
undervalued.
Well, and I just think, yeah, it's definitely a time to be a little bit prudent, and there are definitely easy ways within the portfolio to add some stability to the balance sheet.
Yeah. Good. So why don't we stop there, Dan? We've had a good month of September. We did have a bad weekend for Pennsylvania sports. We had Eagles lost their first game. People are complaining, but they are 4-1 as of
Yeah.
the time of this taping, which is pretty good. Penn State had a bad
Bad
game.
2 weeks for Penn State.
Two losses in a row for Penn State. And then the Phillies lost game one, but game two is
Is tonight.
happening in a
Yeah.
couple hours. We're taping this on Wednesday, October 6th. So hopefully by the time
Monday.
you listen,
Monday.
I'm sorry,
Go ahead.
Monday, October 6th. So hopefully by the time you listen to this, the Phillies have closed out the Dodgers.
Yes.
We'll hope.
Fingers crossed.
Great. Anything else?
No, I think just again, be in contact with us throughout the end of the year. And I will just add, I'll apologize in advance for everyone that's listened through. I have my allergies are out of control today, so apologize for sounding a little under the weather.
I just broke down from my Zyrtec a couple days ago, so I try to go. It's a little drowsiness for me,
Yeah.
so I broke down a couple days ago. So thank you again for your trust and confidence. And so the theme you'll hear in the conversations between now and the next until the end of the year is let's try to do some rebalancing, maybe take some chips off the table, be a little bit more conservative. But we're still optimistic. We still think the economy is strong, and certainly earnings are strong. The AI spending at least continues to roll forward. So we're not clairvoyant, but let's be prudent. So thank you all. Have a great day.
Thanks, everyone. Take care.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.